I'm really excited for our presentation today. It's something I've been working on with Mr. Burgess for quite some time. The Adaptive Cycle Toolkit plugin is one of our best selling over the years. It's an incredible program that a lot of customers have found it to be very, very useful in your trading. And so I'm excited to have the creator of the plugin here today to walk you through it and show you what it can do. And it sounds like we've got people from all over the world here. We have one person from Italy, and I wonder if anybody's any further out than that, but we sure appreciate you joining us. Let me give you a little background on Michael. He's the co-founder and member of the Dynamic Market Lab. He's an avid follower of the John Ehlers research, and Michael received the published editorial credit for his work on cybernetic analysis for stocks and futures. And that book was published in 2004. Michael's got all kinds of background, 20 years worth of domestic and international experience in the controls and process improvement, and we're just excited to have him here with us. So with that, I'm going to go ahead and turn the time over to Michael. Know that one other thing that I think is exciting is that the plugin, the Adaptive Cycle Toolkit, is now available for immediate download. So after you've had a chance to view this and hear about it a little bit, you can actually try this right away. So we won't have to ship it to you anymore. So I'll go ahead and turn the time over to Michael Burgess. Go ahead.
Well, thank you, Dave, and I appreciate everyone joining us today. We have a lot of content, so I'm going to move at a fairly good pace, try to keep it interesting. We believe that the Adaptive Cycle Toolkit really does offer some powerful perspectives on ways to look at market behavior. And before we begin, I should also have our disclaimer that indicates that this product is a product of the Dynamic Market Lab LLC, and that these techniques some consider to be experimental and they're for educational purposes. Just the standard disclaimer that you understand that a substantial loss may occur from trading, and that we're not acting in the capacity of investment or trading advisors, and that viewers or traders who use this product must accept full responsibility for their investment or trading decisions. So with that out of the way, let's take a quick look at our table of contents. What we're going to do today is we're going to talk briefly about the history and foundation for this product, and that's interesting. Just to touch on the biographies of why you should believe that this product is developed by people who know what they're doing. And then we have some sections on why we developed this product, the key features, and then looking at the manuals. Because traders are interested in application, I want to move past that directly to the application that we call trading market modes. So we're going to skip past that, and I think this application will pique your interest, and once we have your attention, we're going to come back to these other areas, because this is a program that has a lot of substance to it, so I want to get to some of these features and other program documentation so that you feel comfortable with using the software. So we're going to kind of do the middle part last. Well, the history, 2005, one of the best-selling add-ons in MetaStock. We've received several honors. The program is based on the work of quantitative expert and published author John Ehlers. It's drawn from his book Rocket Science and Cybernetics, both books, the second one of which I received published editorial credit, as Dave mentioned a minute ago. There are two modules within the program. There's the ADSI and ASI. The ADSI has the signal processing indicators. The ASI has adaptive standard indicators. And we'll talk more about why that's important and why that's distinguishable from some of the features that are in MetaStock at this point. Also let you know, we're pretty much compatible with any version of MetaStock. It's been written so that anything from 8.01 to 12, whether it's end of day or real time, it works. And finally, as Dave indicated, it's now available in a very convenient downloadable format, or shippable if you prefer, but that's something that should appeal especially to people who want to get started or our international customers. And then looking at the biographies, Dave's basically mentioned kind of the genesis of this. I edited one of John's books, and I know how difficult it is to understand his concepts. So I have a unique perspective on translating John's initial work into plain English. And I think that's very important for a user of these techniques. We've gone to great lengths to do that. My co-founder and developer, Brad Ulrich, has extensive experience in technology development, computer programming, received a full scholarship to Vanderbilt University with degrees in computer science and math, and studied signal processing, statistics, and numerical analysis. This is just enough to let you know we have a good solid foundation for producing a credible product. Now, what I'd like to do is I'm going to skip on past these slides, and I'm going to go to our applications. Now, we call this trading market modes because what we're trying to do is identify techniques that let you determine how to identify the mode that you're in the market at any given time, whether it's trending, directionless, cycling. You know, we're not in this to create a broad array of constantly changing techniques that we have to look for each time. We're trying to find logic and tools that are robust enough to help us shift rather easily from one environment to another. First thing we're going to do is we're going to look at how ACT can take a existing robust tool and make it even better. And then we're going to go to the application where we look at buy and sell signals indicated by application of some of these tools. Regarding taking an existing tool and making it better, a number of years ago, as you'll see on this slide 104, David Sepiashvili, who has a doctorate in signal processing, wrote an article in Stocks and Commodities about using some fixed length indicators as a way to measure trend strength, congestion, trend strength, and direction. Now, he used fixed or static variables in computing that. I will tell you that this article is available from Stocks and Commodities for a nominal downloadable price, like $2.95. But basically, this indicator that he created, it would move back and forth between 0 above 1 and below -1 and down. And the stronger it was on the positive side, the greater the trend strength up. The more negative it was on the downside, the stronger the downtrend. And if it stayed locked in between plus and -1, it was deemed to be a congestion phase. Now, I will also tell you that the original code for this in the trader's tips from Equus at that time had some errors in it. So we cleaned up the errors, and we know that the original code had some errors because this oscillator or tool by its definition has to switch between, has to cross 0 and move above to +1 and greater or -1 and greater. And that version did not. So you can be assured that the version we're presenting is a correct version of his original, David's original formulation. Now, this slide, and we'll get back to it if you wish, it describes in detail how Sepiashvili computed this indicator. What we did is we said, let's take those fixed links and let's replace them with some noise-adjusted, signal-to-noise-adjusted functions out of ACT and use their crossing to determine whether or not we were in an uptrend or downtrend, the trend strength and congestion. And then let's go over and we'll look at the differences in the results between the two applications. Skip over here. You'll see in this first slide, his indicator, his original formulation's at the top. The revised version is at the bottom, the ACT version. And remember, when it's between or near plus and minus 1 locked in that area, that's a congestion phase. You can see this period, I'm sorry the screen is a bit small, but in November of 2000, this is IBM, that about a month period in there, the ACT version stayed at or near minus 1 or in between plus and minus 1, whereas his original formulation was deeply into negative territory. Now someone might say, well, yeah, but the market continued to move on down from that. At that point, though, you didn't know this, and for that month almost, we stayed locked in a drifting directionless market. We move on across to 2001 in about April. You'll see between those first two lines before the dashed green line, you'll see once again that his formulation was still in deep negative territory, whereas the ACT version had already locked into a congestion phase. Now, in that point, the market for that 3 to 4 weeks was in fact congested. Now we're going to move over to one thing where his original formulation did surpass ours, and that is in this green dash line. There was an abrupt gap up movement, and his technique caught it earlier than ours. Was that luck with the static, the selection of the static variables? Who knows? But in candor, that was a better move. Moving on over to later in the year, we see again where the next two vertical lines, where for about a month in late May to June, market was drifting, as you can see up above. His indicator was showing a very strong uptrend when in fact the ACT version was showing a congestion phased market, and that's in fact what was going on. We move on over to later in the year, and we see those two widely separated vertical lines. Again, his tool was showing a very strong uptrending market, where in fact what the ACT tool had picked up on, see the drop or the declining peaks, and we were dropping back down towards the congestion phase, a classic divergence, and we were moving into the congestion phase much more rapidly, indicating that something was up and the trend was weakening, and we wouldn't have picked that up from his original formulation. And finally, let's move on over to the next slide, where basically in 2002, in July and August time frame, you see again the two vertical bars where his indicator was deeply below in negative territory, but yet the market was drifting in this period. And as you can see in the same line, the ACT tool was in fact showing that it was in a congestion phase. One other interesting point, as you move further over, you'll see this spike. There was a kind of a spurious result. Obviously, that wasn't a trend takeoff about 6 months later. It's just part of the, I guess, the result of using fixed variables. And during that entire time, without that spurious result, in March, April, and May of that year, we were showing a congestion phase. This is just a quick example to show you kind of how ACT can improve upon an existing tool that's already a strong tool. And it can do so because you can put in factors that adjust with the dynamics of the market move. Now, the other slide, the last two slides, are basically to just show you that for the remainder of that period, the two indicators were fairly much in sync. And I think what we can say is during that 7-year period from 2000 to 2007 in IBM, we identified about 6 or 7 periods in there where we accurately picked up on congested phase markets that the traditional tool would not. I guess there is one last example here, and this is in on the left most part of the slide here. You can see before the big drop-off. Well, it would look like that his tool was portending that, but if you go back and without knowledge of what existed to the right, if you took that out and drew a trend channel, the market was basically drifting sideways. And the ACT tool did pick up the shift to the down move and the breakout of the congestion timely enough to pick up on that, just as his tool did, but it also correctly identified this congestion phase. And then, of course, the rest of the time, the tools were pretty much in sync. So it did really improve upon an existing tool. Now I want to show you an application of basically creating buy and sell signals for a variety of markets. And we're going to use several tools here. We're going to use a 3-bar Laguerre filter. That's correct. Only 3 pieces of data, and you will be surprised at how smooth and responsive it is. Then we're going to use the ACT modified version of his trend quality indicator. I'm going to, from now on, call it the ACT TQI. And then we're going to use a Fisher transformed version of a Laguerre stochastic. Now, we're going to go to the slides, and basically the rules are as simple as this. You will look first, this up above, that is the Laguerre filter on prices, the 3-bar data. And you can see how in uptrends, the prices tend to ride very neatly on top of the indicator, and in downtrends, ride below it cleanly. You can see how responsive the Laguerre filter is because of the very short data length. You can see how smooth it is. You can also see during drifting periods how prices kind of cling to or hang on to the Laguerre filter. The next indicator down is the ACT TQI. And the final indicator down below is a Fisherized version of the Laguerre stochastic that's been normalized for statistical deviations. What's the approach? It's simple. We look for first, where are prices relative to the Laguerre filter up above? Are they above it, below it, or hanging? Then we look below at the ACT TQI. Where are we in the trend strength and direction? Are we in negative territory, indicating a downtrend that's strong, an uptrend that's strong if we're above 1, or are we locked in between 1 and -1? Because that will tell us a lot about what our market mode is and how we should trade. Finally, the Laguerre stochastic that's been normalized to handle statistical deviations ranges between plus and -3 standard deviations. The red lines, by the way, across the chart indicate plus and -2.5 deviations. So what we're going to do is we're saying, are we below the trend and the TQI is outside of the congestion phase on the negative side, and we have a peak out in the stochastic, we're at 2.5 positive or better. If so, it's likely to be a good candidate for a short. Correspondingly, if the prices are above the Laguerre filter, the ACT TQI is above +1, and the stochastic is deeply oversold at minus 2.5 standard deviations, it's a low-risk entry point to buy. We see that one on the second vertical bar. We see in the third one a slight variation of that. In this case, we're above the Laguerre. However, the ACT TQI is indicating we're locked in kind of a congestion phase. Now, it did break out after that, but at this point, we don't know that. We don't have the benefit of hindsight there. However, the Laguerre stochastic is flashing that we're way down at minus 2.5. Even trading that on a congestion phase trade, that turns out to be a very good buy signal. Moving on over to the next vertical bar, we're slightly outside of the congestion phase, but we're also above the Laguerre filter. So kind of a neutral to a slight positive, but we are deeply oversold in the Laguerre stochastic down below at about minus 3. Excellent buy signal. Moving on across, we can see that at this point we take this hook back down towards the Laguerre filter. The ACT TQI is well above +1, and if we were to go down below, the Laguerre stochastic is down at about minus 2.5. It's a beautiful long purchase right there. It's a textbook version. Moving on across, we go to the next two bars that are very closely spaced together, and we see two setups back to back. Prices hook back up under the Laguerre filter in a downtrend. The ACT TQI is deeply in negative territory, indicating strong downtrend strength. And in both cases, you might be able to see the Laguerre stochastic peaks out at well over 2.5 to the positive, meaning this is a heavily overbought item in a downtrend, a good short candidate. And there are a couple others on this chart that, for example, the next one's over, the next three over basically follow this congestion scenario where the prices are kind of hanging on the Laguerre filter. In all three cases, the TQI is locked between plus and minus 1. And in the first case, the stochastic is overbought, this Laguerre stochastic. It's a good down move. The other two cases, the Laguerre stochastic is deeply oversold. They're good purchases, long moves. Again, just remember, you wouldn't know necessarily that they're going to break out like that. And I should indicate that sometimes these congestion moves like this, they're not as highly probable as a strong trending move. So my favorite setup is when the TQI is clearly above +1 or clearly below -1 as a confirming indicator. But you can often get very good signals even in the congestion phase. Just be aware that they're not as highly probable, and so you should adjust your risk management a little bit. I'm going to move along to several more examples on slide 2 where I've got, it's about the, let's see, it's the fourth line over. Again, we're in a congestion phase. The TQI is right about -1, not clearly in a downtrend, but the stochastic is overbought, and we have what ensues is a 4 or 5 point down move or short immediately thereafter. We move on over to about the 5th or 6th line. Here we have prices below the Laguerre filter. We have the ACT TQI finally breaks out a little bit to below -1, and the Laguerre stochastic is at about +3, and from there on out, as you can see, we have a good down move of about 10 or 11 points from there in IBM. Moving on over, the next line we have prices. There are two vertical lines that are very closely spaced. we have the prices that are above the Laguerre filter. The ACT TQI is breaking out or already above +1 and rising strongly. In both cases, the Laguerre stochastic is deeply in oversold territory. Excellent buy candidates. Now, we move over further to one where we see about the, it's about the 7th or 8th one over, where we have prices hanging on to the Laguerre filter, and we see how rapidly the ACT TQI is starting to drop. And we have, in that case, our Laguerre stochastic is deeply oversold. It ends up being a good purchase point. Now, one thing I'll mention, see how thereafter prices in IBM start drifting sideways in the latter part of December for a couple months. Notice how the ACT TQI, that trend strength, is dropping rapidly, the two peaks. One peak is lower than the other. This is the same thing we saw earlier in our example comparing to the original version of TQI. This was a good tip-off that that trend is really dying on the vine. And if we've been long throughout this process, it's time to reconsider. We'll move on over to, see, it's about 3 lines back. We'll see again where the 3 lines back from the right, where we'll see that the prices are hanging onto the Laguerre filter. We're deeply in negative territory on the ACT TQI. Laguerre stochastics is up at about +3. Excellent short position. And then the last 2 lines on here are similar things where prices have hooked back up towards the Laguerre filter. We're in negative territory in the ACT TQI in both cases. In both cases, the Laguerre stochastics peaks out at about at about 3. They both end up being excellent short candidates. And we have several more that I can go through. The ones on the next slide, there's one about 3 lines over where again we have the Laguerre filter indicating that the prices are choppy because it's kind of clinging on. We haven't quite picked up yet that we're not still in a downtrend on the TQI, so we've got this negative tilt, and the stochastic, Laguerre stochastic, is still heavily overbought. It ends up being a quick about 4 to 5 point down move or short. Moving over to the 4th and 5th line, we have 2 entry points here where prices in either case hooked back to the Laguerre filter. And in both cases, we were moving out or were already out of the ACT TQI congestion phase into negative territory. In both cases, the Laguerre filter was already peaked out, and you end up with some excellent short positions. And I'm going to basically, there are other examples here that we can cover, but what I'd like to do, the slides take you on out through all the way through 2007, and there are more of them that we can cover, but I want to take a minute and get back to the rules a little bit more closely. And I'll just show you some more of the slides where you can see, for example, in late 04, you can see over on the very far left where you have, again, this hook. You're above the Laguerre filter. We're in a congestion phase in the ACT TQI. We're heavily oversold on the Laguerre stochastics. Good up move. The next 3 to 4 moves were all underneath the Laguerre filter. Prices are either congested or in the next 3 are breaking out of that congestion phase to the negative trend, and we have the Laguerre stochastics in each one of those 4 cases heavily overbought, some excellent down short signals. So I'm going to go ahead and move on back for a minute. I wanted to give you a taste of what the product could do. And once we'd set up these 3 indicators, I might add, with this approach, we really didn't have to do anything else. We didn't change anything else for the 7 years. We could fairly easily distinguish between a trending market, a heavily uptrending market, or downtrending market. So we could adjust our strategy accordingly. And if I go back to slide 1 on this, where I talk about David Sepiashvili's approach versus our modification to it, really all that we did is used his same approach that's described here, and then over here on the next page we describe how we replace those with adaptive nonlinear functions driven out of some of Ehlers' research. And these functions are constructed so that they are fed off of a signal-to-noise calculation that rapidly speeds them up and slows them down. So they cross faster or they slow down when noise indicates that they should. And that's really essentially all that we did. But you could see the indications in these slides where in 6 or 7 cases, or a total of about 4 or 5 months out of that 7-year period, we picked up on congestion phase markets much better than the traditional formulation of that tool did. And then as far as the actual trading process is concerned, we only put 3 indicators up on the screen. The Laguerre filter on the prices, just like a moving average. That's all that it is. And then we had the ACT TQI, and then we had the Fisher version of the Laguerre stochastic. Now, I'm a big believer that traders can get very confused with the tools they're using if they have too many. So you need to keep it simple and straightforward. And that's what we've done. The Laguerre filter is your earliest warning of a trend change. That's it. And it's smooth, it's fast. The ACT TQI helps you measure the trend strength. Are we above 1 and so we're in a strongly uptrending market? Are we below -1 so we're in a strongly downtrending market? Or are we locked in between the two so we're in a congestion phase? You could use, if you're a trend follower, just simply use the crossover of the Laguerre filter as your earliest warning of a signal and confirm that with the ACT TQI to trade in the direction of the trend. If it's above the Laguerre filter and the ACT TQI is above +1, it's a trend buy. Similarly, if the situation is reversed and you're below the Laguerre filter and the ACT TQI is -1 or below, a downtrend. What we focused on was an interesting way to take advantage of trend and what's called mean reversion. That's what's on those slides. Mean reversion is nothing more than simply saying we're going to use the trend to our favor and we're going to try to intelligently buy dips in an uptrend and sell short peaks in a downtrend. Well, that's all well and good. Well, how do we do that with any precision? Well, we use the Laguerre filter and the ACT TQI to tell us whether we're in an uptrend and how strongly we're within an uptrend, or in a downtrend and how strongly we're within a downtrend. Or if we're neither one, if we seem to be locked in between. This is where the Laguerre stochastic comes in. It is a Fisherized version, and what does that mean? It is a century-old statistical technique that takes data that bears no resemblance to a normal distribution, just like stock market data does not bear any resemblance to a normal distribution, because if it did, wild events would not occur as frequently as they do. And it transforms it into something that mathematically really is transformed to a normal distribution very rapidly. And this is something that John Ehlers talks about in his books, and we talk about in our manuals. You can use this technique to convert tools to something that has more statistical reliability. That's what we've done. And you use the peaks in the Laguerre stochastics to help sell short, and you use the deep valleys to help buy. And I will tell you that any of this special code that relates to these indicators, we can supply to you with the purchase of the software. That's not a problem at all. And so that we kind of keep moving on with this, I want to jump back for a little bit, back to kind of what else is in this program, or how we approach this. And I'm going to get back to, why did we do this? I really was interested in signal processing indicators, and I wanted something that rapidly adjusted to a market's dynamic behavior without the need for constantly adjusting our parameters. But why MetaStock? Well, I liked MetaStock because MetaStock has very much an Excel-like function feel. You know, you drop something in one line, and it computes something like a regression output. You don't need to program the whole regression equation. The other thing I realized was that if you could create a bank of these indicators, a bank of the signal processing tools, you could create kind of a stackable Lego block approach to programming customizable complex functions. Remember Lego blocks when you were a kid and you just stack them together and they all fit? Well, let's say that you wanted to take a signal-to-noise filter and then you wanted to use that to adjust a moving average. That would take you several pages of code in a complex language, and then you'd have to debug it, compile it, get all this stuff to get it into MetaStock. Well, the way we've done it by creating these banks of tools, you could create one variable equal to that signal-to-noise ratio and then turn around and drop that variable in your moving average, and you have a very complicated noise-adjusted nonlinear average in about 2 lines of code. So it's this kind of stackable Lego block approach to programming that intrigued me. The downside, it's hard to do in MetaStock unless you have this bank of filters, because the underlying routines are more complex than the regular MetaStock programming language that we all use would accommodate. So our solution was to create this bank of filters, explain them in plain English, provide you a rich array of examples in the manuals, and show you how to use it so that you could feel comfortable with it. And then finally, we've now introduced it into a downloadable format for you, so it's easy to work with. What are the key features in ACT? I mean, ACT has a number of functions that minimize or eliminate lag, such as the instantaneous trend line, which has a 0 lag. It's a 0 lag average. There are other tools in there that also help to minimize or eliminate lag, because that's what traders need. We also have features that help you identify trending versus cycling markets, because you need to know that. For example, one of the tools we've touched on today is a modified version of an existing tool, the trend quality indicator, or one of the tools that Ehlers wrote about, the sine wave indicator, that's discussed at length in our manuals. The ACT also helps you identify noisy markets so that you know when to kind of step aside or stay in. Is it drifting? You know, you don't want to be whipsawed back and forth if you're going to try trading trends. And that's where this signal-to-noise ratio and this mama-fama approach we talked about earlier helps you in that regard. And we explain in the manual why and how that's the case. And ACT also helps you filter very, very short data arrays for very responsive, smooth indicators. You notice how we use that Laguerre stochastic? That is a special mathematical warping of data to get very smooth data with very short data lengths. Most of the time, you're only using anywhere from 4, 5, or 6 pieces of data. We use 3. Now, we allow in our formulation people to use anywhere from 3 to 8, and Ehlers only talked about 4. So to our knowledge, this is one and only formulation we're aware of where that flexibility is available. I think you'll really like this because you noticed how the Laguerre filter moved so rapidly but yet was very smooth. Similarly, that Laguerre stochastic down below was an oscillator that was quite smooth, and once again, it only had about 3 bars of data in it. So most oscillators are very noisy. Now, I will tell you that we provided separate functions in here for the Laguerre because if you simply take a Laguerre filter of prices, you wouldn't want to take a Laguerre of an RSI or a Laguerre of a stochastic because it's not taking the Laguerre of the end function that counts. It's running the prices through the Laguerre transform before you compute the final indicator. And that's why I have bolded here that a Laguerre of an RSI is not the same as a Laguerre RSI. In the first case, the Laguerre is applied after you create the RSI. In the second case, the Laguerre filter is applied to prices before the RSI is computed. And it's that latter approach that we have used and Ehlers used to create these very, very smooth filters. So you need to run them through the Laguerre filter first, but we've already done it for you in these different oscillators. But you have the generalized Laguerre filter to create averages and other things, basically, at your wish. And then finally, the ACT transforms prices or indicators to approximately normal distributions to better identify extremes. That's what this Fisher transform does. And it allows us to better identify a relative price extreme with more certainty. And within a price range or a range of values, a certain look back. And then you say, well, that's fine. Well, how do I know what look back I should use? Well, that's where our cycle period functions come in, because our cycle period functions within ACT help us to adaptively identify what the appropriate range is to look back and determine what the relevant extreme high or low is. You're never going to get the absolute high or low. I mean, if we knew that, we would, as they say, we would all be wealthy. No one really knows that without hindsight. But we can do a much better job of identifying relative peaks and relative dips within trends and other lookbacks if we use the Fisher transform. And so these are some of the features within ACT. We want to talk briefly about the program manuals. We spent a lot of time in developing 3 manuals: the main manual, the summary manual, and the formula primer. The main manual is a 93-page comprehensive documentation. It includes information on the installation and use, plain English primers on signal processing, John Ehlers research, adaptive indicators. It shows the concept behind each indicator, the indicator format, the variables, how you can take these tools and create even more advanced custom indicators using this Lego block approach. And in other features that relate to some of Ehlers' pre-programmed strategies, and basically is rich with content and examples. The summary manual is a 21-page quick start manual. It includes information on applying these templates, advisors.
Hey, Michael?
Yes.
Hi, sorry to interrupt you. We actually have a couple of questions we want to make sure we get to before we run out of time. Would you mind fielding a couple of questions at this point?
No, go ahead.
Well, there's been Barry's been very patient on a couple of points here. He'd like to learn a little bit about some of the documented usage as far as let me read it exactly as he phrased it here. He would like to know, the audited results. Do we have like some type of an audited result or something we can draw to as far as success patterns for the ACT module?
Well, the ACT module, I guess the short answer is this isn't a closed-in trading system, and it was never meant to be. This is a set of approaches that allows someone to create their own system or approach. And so I guess that's really the way I could answer it.
Okay, and then there have been some other questions just talking about, where some of the like the best system in your tools.
The best system, I would think for, okay, that's why I outlined the example that I did, because you can use those combination of 3 tools on any tradable. If you're buying and want to trend follow by buying stocks or buying options, you would use something like the Laguerre filter and the ACT TQI. If you're mean reversion trading, you would use the tools as we've outlined. If you're selling options, trying to capitalize on trend decay or time decay in the options, you would look at those tools and try to identify congestion phase markets to sell options, sell spreads or straddles. Are you still there, Dave?
Still there?
Yeah. Okay. Go ahead.
Sorry, I lost you there. I was just checking on this question that we just had from Italy about the TQI, and is that a formula that you can share and send out to people who already have the program?
Yes.
Excellent. Okay, so we can get that to you then. Mary, yes, the program is downloadable now, and you download that.
One thing else I might add is, the last document in here is the ACT formula primer, and it shows a lot of detailed step-by-step examples of working with these tools, and it's very hands-on. We spent a lot of time on the documentation so that you can answer a lot of questions and for yourself and put this in plain English, so these concepts are not really beyond you, because otherwise it's somewhat intimidating for people to try to deal with many of Ehlers' techniques. I mean, he writes like many engineers do at a level of mathematics. So I think you can take comfort in the fact that, from what I understand, many people at MetaStock believe our manuals are quite clear and very easy to follow and understand. And then I guess the other thing I will tell you is, just like MetaStock offers some coding assistance for a fairly nominal price on the traditional MetaStock code, I can similarly work with people on using the ACT functions at a fairly nominal price. I'm available on Skype, and my address is in there. It's michael.miller.burgess Skype. So
yeah, we have a question about getting manuals sent out, actually. And if you've lost your manuals, Barry, we can get you another copy of those out. Just contact our sales department, and they'll be able to, just for the cost of shipping, send out those manuals as a replacement. And Mary has a question.
Okay. No, you have to create the indicators just like you create any other indicator in MetaStock. You have to, put it into your custom indicators and then plot it. And I will tell people that for all the code that I've shown in the examples today, I can supply any modification on that. What we've shown today, I can have that code available, to MetaStock to send out to any buyer, any purchaser. So,
So there's no additional cost for that service, Michael?
No, there isn't.
Awesome.
I have that. I guess one of the last things I wanted to show is a sample page kind of out of the program documentation. This is a tool, the Laguerre RSI, and it kind of shows you what it looks like in the manual. Provide background on it, the name, the format in the MetaStock code. You can see how it looks like a MetaStock formula, the input variables, what's in the input variables, and basically how to use it. So again, we've gone to a great deal of work to try to make sure this is very clear.
Okay, and we have a couple other questions here coming in. Brian wants to know if he can examine these manuals, before buying the software. And of course, we have a special offer for you folks who do not have the plugin. Remember, it's immediately downloadable. We can set that up for you, and you can have it and be working with it immediately. But there's a special offer for those of you who are in the webinar today. We're going to get a $100 discount on this plugin. Normally, it's $399. And we're going to go ahead and give you $100 off. And of course, you'll get those manuals with that, Brian. And as with all of our products that we sell here at MetaStock, you always have 30 days. And if you decide after that 30-day period that this is not for you, or it hasn't benefited your training or your trading, go ahead and we'll refund you that. But if you're like most people who buy this plugin, most people buy it and hang on to it. I'll tell you, I've been with MetaStock many years, and the ACT systems are one of the most popular as far as people who buy it and keep it and add it to what they're doing in their trading. It's something that can go in there and increase your likelihood of success through the systems you're using. So that would be the best way for us to get the manuals to you, Brian, is if you go ahead and purchase that. But know that you have a guarantee.
I will tell him that Brian, that I discovered the article from Saakashvili about a year or two after he wrote it, and I thought, this is intriguing. This guy's got something here. I wonder if I can improve it. And so there was a case about 2 years after we had created ACT where I found a way to improve an indicator or tool that was already out there that already had quite a bit of value to it. So, I'm one of the co-founders or co-developers of this, and I still am finding ways to increase the use. We wrote this to be exactly that, where it was you could use these tools to create your own approach. Any other
questions from you folks here? This has been great questions. Well, if not, let's go ahead and make sure you have contact information for us. I think you all know how to get us at MetaStock.com, or you can go there and you can order it online and receive that download immediately, or you can go ahead and give us a call, and we're happy to set that up for you as well. The sales lines are closed for now, but we can answer that call for you tomorrow. And you'll need to mention that you were in this webinar when you place that order to get the $100 off. You won't be able to do that through the automatic system. You'll have to call in to get that special offer. So just mention that you were in the webinar with Michael Burgess, and you'll get a $100 discount on the plugin. Looks like we have another question coming in here. Okay. It does look like some of the previous owners of the plugin don't have some of the newer manuals, and so if you need to get updated manuals, once again, we can set that up for you. You just need to contact our sales department, and we can get those sent out.
Yeah, Dave, you should. I think I sent you the latest edited, updated manuals.
We have them, exactly. All you need to do is call us up, and we can either send those over to you as a PDF, or we could actually get you hard copies if you'd like.
And there are 3 of them: the main manual, summary, and formula primer.
That's right. And they're fantastic. You know, Michael mentioned this before, but the manuals that have been created for this product have been one of the biggest selling points for people who actually use these tools. They're very easy to use. It kind of demystifies what has normally been a very difficult kind of line of thinking with the Ehlers theories and concepts. And so Michael does a really good job of putting that into a format that's very usable in your trading. Well, we sure appreciate you taking an hour out of your days with us, and we hope that you'll contact us and we can get you a copy of the discounted copy at the special rate of the ACT plugin. And certainly if you have any other follow-up questions, you can let us know here at metastock.com. You can drop us a line or give us a phone call. Thank you, Michael, for joining us and for giving us a great presentation today.